Hello and welcome to Chapter 18 on the mortgage market. So first of all, we're going to talk about the broad picture. So what is a mortgage? You hear people talking about mortgages all the time, just in general conversation. Well, a home mortgage, of course, you can have commercial mortgages as well, but let's just focus on the home one to begin with. It's a loan for which residential real estate is used as collateral. So in other words, if I buy a home, often I don't have the amount of money that the home costs right up front, so I take a loan for that home, and the loan for that home is called a mortgage. In some countries, they actually just call them home loans. They don't call them mortgages. So in South Africa, they don't tend to talk about mortgages. They tend to talk about bonds. So they call it a bond for your home. So different places have different language for these things. But ultimately, anything that's a loan that's taken out against a home is by definition a mortgage. And the lender may take possession of the property. It's called a foreclosure if they do, if the borrower fails to repay the money. And that's usually triggered because the borrower fails to make an interest payment. Incidentally, in Texas at the moment, they are looking at a large number of properties defaulting because the federal government had allowed people to miss mortgage payments during the COVID crisis, but those payments are now due from May onwards, I believe, and some people still don't have jobs and can't afford to pay their mortgages. So we're expecting a spike in foreclosures coming up in Texas this year, 2021. According to the National Association of Home Builders, the residential investment spending has averaged about 3% of GDP. Now, by residential investment spending, what we mean is, of course, new houses. So if you're buying a second-hand house, a house that's already been built, that doesn't add to GDP. The only bit of the transaction that will add to GDP is the service for the home, for the realtor, in terms of transferring the home from one owner to its new owner, that is you. The housing sector, though, accounts for approximately 15 to 18% of the entire US economy. Why is there this difference between residential investment? Because remember, that's new homes. So housing sector means anything to do with housing. So any appliances that go into houses, any remodeling of houses, anything to do with the housing, that represents 15 to 18% of the entire US economy. Housing services average between 12 to 13% of GDP each year. Housing services means basically renting property. So when you buy a property, one of the things you have to do is to put a down payment on the property. So this is the amount of the purchase price a buyer must provide out of his or her own financial resources. And typically, I'll jump to the penultimate bullet point there, typically it's 20% cash is the minimum. Some lenders will go to 18%, but typically it's 20%. So it means that financing 80% of the property. Now, what are we talking about if we're looking at 20% cash? Well, the median house price, US house price in 2017, it was 320,000. It's now gone up to 340,000. But that can vary by market, of course. So Boston has been a particularly hot market. So the Boston median house price has gone from 410,000 to 665, nearly 666,000. And if you want really hot real estate markets that basically price a lot of people out of owning anything in this city, then go to San Francisco, where the median house price was 860,000. It's now 1.1 million. So basically, if you were buying a house in the US, on average, you're going to have to put down, at the moment, 34,000 would be 10%. You're going to have to put down about $68,000 on average to buy a home. That's the 20%. By the way, for new home buyers, there are schemes available by the government which allow you to put down less than 20%. But then you have to get mortgage insurance as well. So we'll talk about that later as well, the mortgage insurance. But it actually is covered in that last bullet point there, which says if 20% not met, the borrower may have to seek private mortgage insurance. As I said, with the first time buyers schemes that the government runs, those do require the private mortgage insurance to be taken out. If we're going to break this down by region, of course, we can see that it differs substantially between different regions in the country. What's also interesting is that home prices are up considerably compared to last year. So in the West, you can see they're up about 14% to 468,000, Northeast. On average, to 354,000, it's up 17%. South, which includes Texas, is 270,000, which is up around 15%, and Midwest is up to 239,000, which is up 15%. So, private mortgage insurance, or PMI, it's an insurance policy that pays the lender of the mortgage in case of default by the borrower. So why is that 20% important? Well, because, as I said, falling below 20% in terms of the cash that you bring to the table means that you're also then going to have to get private mortgage insurance contract, and that's going to cost you more. The policy typically pays the lender a percentage of the outstanding loan principal, accrued interest, and expenses. And the state laws usually state this percentage may be no more than about 25 to 30% of the claimed amount. Let's now turn to the difference between fixed rate and adjustable rate mortgages. For the most part, borrowers in the US tend to go, for good reason, to fixed rate mortgages. Of course, this is a question of timing as well. For instance, on my property, I managed to get my rate down to 2.6%. But I had to get the timing right. Mine was on a refinance. Now, 2.6% on, in my case, it's a 15-year mortgage, is really very good. I haven't seen mortgage rates this low I've never seen mortgage rates this low, full stop. Mortgage rates are now moving up because of the stimulus. and that is now, putting the economy on a track to kind of growing incredibly fast. And in that case, inflation tends to rise, and through the Fisher effect that means interest rates are going to rise. And the market's expecting that. So if you look at long bonds, which usually are linked to mortgage rates, because mortgage rates tend to have a long period to maturity of a mortgage contract, then you'll see in the bond market that those long bonds have definitely moved up in terms of their interest rate, in terms of their yield. Okay, why do most people go with a fixed rate mortgage? Well, the good thing about a fixed rate mortgage is it gives you certainty about what you owe. I know, because mine's a fixed rate mortgage, that every month this is the amount I'm going to have to pay. I don't have to think about it. I can set up a payment scheme that will draw the money straight out of my account. So what's the other alternative? Is to go with an adjustable rate mortgages, or an ARM as some people call them. And that's a loan where the real estate is used as collateral and the interest rate paid by the borrower may be changed by the lender under the terms stated in the loan, usually when the market interest rates go up. And of course, which market interest rate you're talking about is an important point here. So the adjustable rate mortgages are structured so that the initial interest rate on the mortgage remains constant for a set period, anywhere from 1 to 5 years. Usually that's about 1 year. It stays constant. After the initial period ends, the interest rate can be adjusted based on the terms laid out in the mortgage agreement. So the interest rate could fall or it could rise from that initial fixed level. Typically it rises because that initial fixed level is usually at a very attractive rate to get people to sign up. And of course what that means is that, because it's an adjustable rate mortgage, is that the lower the interest rate is in the economy, the lower will be the monthly payment for that individual. Conversely, the opposite way around as well. The higher the interest rate in the economy, the higher the monthly payment's going to be. So in other words, essentially the mortgage payment then becomes linked directly to the interest rate in the economy. Okay, let's start talking about insured mortgages. For this, we need to get on to talking about the Federal Housing Association and the VA, Veterans Affairs, part of government. So if loans are federally insured, that is, that they are taken out with FHA, by the way, first-time buyers schemes are underwritten by the FHA. The VA obviously does veterans, and then they have a lower interest rate. FHA mortgages require as little as 3% down payment, so those are typically for first-time buyers who qualify. And to qualify, you've got to have an income less than a certain amount, and there's a bunch of qualifications that you have to meet. VA loans are made to the veterans, of course, and their surviving spouses and families. FHA and VA loans require that certain borrowing restrictions must be met. In other words, your current debt to income ratio must be below a certain level. You must have a good working history and credit. A lot of people ask me, well, does that mean to say that I need to take a credit card? Yes, it does. You need to have evidence that you have a credit card history. In other words, you have history of keeping a credit card, not spending on it, or spending on it and making sure you made the payments on it in time. And that you also have to have a steady income stream. So they need to know where your income is coming from, and it needs to be uninterrupted for a period of time. Then you qualify and you can get these lower rates. There's another way to get lower rates even if you don't qualify under those schemes. What you can do is essentially pay points. I find this rather deceptive. When I went for my refinance, I asked them if they could get me the lowest rate possible. And all they did was add points. What does that mean? What it means is that you pay up front for a lower interest rate. So you make interest payments at the beginning of the mortgage, and in exchange for paying that payment, the lender basically lowers the interest rate on the mortgage itself. So paying 1 point means that the borrower pays 1% of the loan amount at the loan closing. In other words, the meeting where the borrower signs all of the loan paperwork and gets the keys to his or her new house, condo, or whatever. So this is what I find a little deceptive, is oftentimes, unless you look very carefully at the quotes that they're giving you, you wouldn't know, and they don't have to disclose this to you either, you wouldn't know that you're actually paying for it up front. So I insisted with my mortgage provider that they remove all points so I could see exactly what rate I was really paying, because paying points is really a false way of lowering your interest rate. Now, in terms of the mortgage payments, and let's stick with a fixed rate mortgage because that's the most common anyway. These are a monthly amount that you pay, but that monthly amount consists of both a principal repayment, so that's a repayment on the actual money that you borrowed, plus the interest that will pay off the loan in full by its maturity. If the payments pay off the loan in full by the end of the loan is said to be fully amortized. What that means, though, is that the mortgage lender has an incentive, of course, for you to pay off the interest first before you start tackling the principal. And all the mortgages I've ever seen do exactly that. In other words, to begin with, you're hardly touching the principal. You only do that once most of the interest is paid off. So if you think about that, if you took out a 30-year bond and then you decided 15 years into it that you wanted to cash it in and buy another property with a different mortgage, that means that for those 15 years of the 30 years, you've been paying mostly interest. You haven't really been paying much at all on the principal. That's an important point, because what it means is that if in your contract you can make additional payments, in other words, pay the mortgage but also pay more than the mortgage, and those payments go not to the interest but to paying down the principal. So what they usually say is that you should get a mortgage that you can easily afford right now, and then try and make additional payments on that mortgage so that you're actually paying down some of the principal as well. Now, of course, if you live in New York or Boston or San Francisco, that's going to be hard because the price of property is high. Let's see how that actually works then. Let's compare a 15-year mortgage with a 30-year mortgage. So the top table here looks at a $136,000 15-year fixed rate mortgage with a 6% annual interest rate. Now, of course, that's a very high interest rate as things go right now, but it doesn't matter what the interest rate is. What we want to see is, how much is paid and how often, and what is paid towards the principal and what is paid towards the interest. So if we look at year one of the mortgage itself, then the initial balance is $136,000. So in year two, period two, you've made a payment of $1,147.65, but 677 of that has gone towards your interest, and only 467, sorry, has gone towards the actual principal, goes towards the actual principal. So you can see through time, when you get to, for instance, 180 months into the mortgage, basically, and that's the final payment. In this case, in 2031, your final payment, then most of the payment will be going towards paying off the principal. So you can see 1,136.23. So all but $5 and change has gone to paying off the principal. I think what comes as a big shock to people, and it did to me when I saw this, is the final column, which says that if you get a 15-year mortgage and you just make the payments over those 15 years, actually in total you're going to end up paying an interest rate which amounts to $70,500, over $70,500 worth of interest. So that's just payment in order to, take out the loan, basically, or to have the loan. Now, obviously, if you go for a 30-year mortgage, and you can see this below, in this case with a 4% annual interest rate, you can see how it works here. So when we reach the 180, well, we don't have comparability here, but when we reach 48, so let's just look at 48 with the 15-year fixed loan, you're paying $591 in principal, $556 in interest. Now, if we move to the 30-year with a 48, so 4 years into the loan, then you're paying $229 to the principal and $420 to interest. Why? Because that interest builds up a lot more over time with the 30-year mortgage. So monthly payment increases from $815 for a 30-year mortgage to $1,147 for a 15-year mortgage. So the payment would be, sorry, it's a different rate in this table, but it would be with a 6% rate, it would be $815 for a 30-year mortgage. Of course, the amount of interest that you pay on a 30-year mortgage is, it's astonishing when you think about it. You borrowed $136,000 and you end up paying $157,000 just in interest over that 30-year period. And what you should look at in these tables is how much faster the principal is paid down under the 15-year mortgage compared with the 30-year mortgage. The problem with the 30-year mortgage, the 30-year mortgage is really unheard of in other countries, by the way, but it is available in the US. But the problem with it is that you end up paying a whole load of interest on the 30-year mortgage. And of course, when you look at the principal payments that you're paying on the 30-year mortgage, it's hardly anything to begin with. The actual principal is hardly changing. You can see that it's gone from $136,000 to $129,000 roughly after 4 years. Considering you're paying a lot every month, it hasn't changed all that much. Why? Because you're paying the interest, of course. Okay, let's look at some other issues to do with mortgages, taxes and insurance here. In addition to interest and principal, most people escrow or save for property taxes and homeowners insurance each month. I have an escrow account set up for mine. Basically, my property taxes get added per month to my mortgage payment, and the company I've got my mortgage with essentially pulls that out and sticks a tax payment in this escrow account. If I had homeowners insurance, it would do the same thing too. So part of your monthly mortgage payment is the escrow payment as well. And the property taxes are the main source of revenue for many local government entities, including cities, counties and school districts. And the property tax is usually calculated as a percentage of the assessed market value of the property. Mortgage taxes on real estate for primary residents can also be written off against income. So one of the advantages of having a mortgage is the fact that you can take that interest payment that we looked at in the previous slide, which is part of your mortgage payment, and at the end of the year you declare that on your tax forms, and that gives you basically a credit. So in other words, what the government's doing here is it's subsidizing home ownership, because of course if you paid rent, the government's not going to give you any money for the rent you pay, but because it's interest, then they do cover it. The Federal Reserve estimates that homeowners insurance averages about $3 per 1,000 of the home's purchase price. So it's not that expensive, but I mean, it adds up. So if you're purchasing a $300,000 home, then it's going to be 300 times 30. 300 times 3. So it's not nothing. 300 times 3 is 900. So that would be the insurance payment. Let's move into some other types of mortgages. So these are kind of variations now. So what happened in the early 2000s was that basically a bunch of new companies sprung up that were doing all sorts of different and imaginative new mortgages. And there was no one really to regulate this. So it became a bit of a Wild West. So if, in other words, you didn't have any money, there was an incentive by the people selling properties because there was a housing boom going on at the time in the early 2000s, to get the people financing the purchases of those properties to scale back how much needed to be put down as a deposit. And mortgage lenders started to offer what we call zero down mortgages. In other words, you could purchase something with nothing put down, no initial deposit needed to be put down. This was a mistake, looking back on it, and it's of course been corrected now. But the default rate on mortgages is lower when borrowers have some skin in the game. In other words, if you've already put some of your own cash into the property, then you're more concerned about defaulting, because you realize you're basically handing that money to the mortgage company. So if you put $30,000 down and then default on the property, then the mortgage company has the right to seize that property and sell it to recover its funds. So you're basically, if you put $30,000 into it, you're basically giving that $30,000 to the mortgage company. So with the zero down, if you don't have to put anything down, then there's nothing really to hand to the mortgage company. So it's very easy to walk away from the thing, because you're paying your monthly fees paying your monthly payments on the mortgage. But if you stop paying the monthly payments and you just move out, nothing's going to happen. You're not going to lose anything. Now it's virtually impossible to get a zero down mortgage. Now these teaser rate arms were also a big problem in the early 2000s. So these adjustable rate mortgages traditionally have lower initial interest rates than do fixed rate mortgages. They just do. But what happens is that with these ARMs, the interest rates usually stay low for a certain period of time, and then they snap back to where they should be. And that usually entails an increase in the interest rate, and that means an increase in the payments. So that's one of the problems with these teaser rate ARMs, and they're sometimes called balloon mortgages. And these balloon mortgages were actually very, very suitable for people who wanted to flip houses. In other words, essentially to buy a rundown, beaten up house, redo it, remodel it, and then sell it again. So to finance doing all that, the cheapest way was to take one of these teaser rate or balloon mortgages. Hopefully you could do all the work that you needed to do in the time when the rates remained low, and then by the time you've sold it, you don't have to worry about the rates snapping back to where they should be and your payments going up because you've sold it already. You could also, and this was particularly the case during the early 2000s again, get negative amortization home mortgages. So this is where the payments on the interest payments were so low that they didn't even cover the interest rate on the mortgage. And basically what was happening was that at the end of the month, the mortgage balance increased because you weren't making a sufficient amount of a payment on the interest, so therefore the shortfall was just added to the principal. Most negative amortization mortgages allowed the negative amortization to go on only for the first few years of the mortgage. This was also a feature of many of these balloon mortgages. They were ARM type mortgages, yes, but they were negative amortization, which then ballooned once a certain date had been reached. And these were in particular marketed to house flippers. Things got so bad in the early 2000s. I remember listening to radio programs talking about how people trying to get a mortgage in California found that the company giving them the mortgage didn't even want to see pay slips or anything. This was known as a no documentation house mortgage, and it was incredibly risky, if you think about it, to give money to someone when you had no evidence that they had the income to even pay the interest on the mortgage that you were giving them. And the potential for deception and fraud was really overwhelming with no documentation. Sometimes it was the loan originator who would falsely report the borrower's financial status to ensure that the mortgage application would be approved. These guys who were writing these mortgages, who was writing the contracts, they made out, with a tremendous amount of money because they were given commissions for every single mortgage that they wrote. But if they didn't have to worry about a whole bunch of details like, does the guy who's borrowing the money actually have the wherewithal to pay the interest rates, or can we possibly bury the fact that there's a balloon payment here? In other words, the thing balloons after a certain period of time, and it's a negative amortization mortgage. We can just bury it in the fine print halfway through the paperwork. That's exactly what happened. They did. So a lot of people were signing these things without realizing what they were signing. Now you're probably thinking, oh gosh, why didn't they just read the mortgages through? Well, let me tell you, when you go to signing, those of you who haven't signed for a property yet, you'll see when you go to signing, there is a huge pile of paperwork that needs to be signed. And there is absolutely no way that you can read every word in those documents. Otherwise, you'd be there for hours and hours and hours. And most closing meetings only last an hour. They're only booked for an hour. So you don't have time to read through the whole thing. Even with my refinance, they only sent me the documents hours before the actual meeting where I was to sign these things. I complained about that, but that's how they do things. They do things at the last minute at the moment because they're being completely overwhelmed with refinances. Problems in developing a secondary market for mortgages. Once these mortgages have been given out, if companies wanted to then loan out more, and of course the market, particularly in the early 2000s, was a very hot real estate market, so most financial institutions wanted to get rid of the mortgages that they had on their balance sheets as assets and sell them to someone else. But mortgages are too small for most institutional investors to be bothered with. Mortgages were not standardized, they matured at different times, they have different interest rates and different terms. So they're very difficult for an institutional investor to analyze. Now, what happened was that, and this goes back in time, so there's a nice kind of section in the book that covers the origins of Fannie Mae, Ginnie Mae, Freddie Mac. They're all government agencies, and they basically all underwrite mortgages by bundling, particularly in the case of Fannie Mae and Freddie Mac, bundling these mortgages together and selling them to institutional investors. And we're going to see how that works in a second. But they guaranteed many of these mortgages and then securitized, in other words, bundled them together and serviced them as well. So what that meant is that the people who'd taken out the mortgages, of course, would make their payments, but the mortgages have been sold on, bundled up by Fannie Mae and Freddie Mac, or Freddie Mac, and then sold on to another institutional investor, and then they would get the interest payments funneled through one of these government agencies. Now, Fannie Mae was a government agency, and now no longer is. It's a private agency. You can buy shares in it. In fact, it's a private business. So, what was the securitization that they were doing? And there was bundling it together of these mortgages and then servicing them. What was the product that they were selling to the institutional investors? Well, it was called a collateralized mortgage obligation. So what that was, as I said, is just a bundle of mortgages. Now things got even more creative with CDOs. These are collateralized debt obligations, which often contain mortgages as well. So these can be car loans, mortgages, boat loans, who knows what's in there. Most of them are issued or guaranteed by Ginnie Mae, Fannie Mae, or Freddie Mac. So these agencies were at the center of this new market for these CDOs and CMOs. And to address these two types of early repayment risks, both of which reduce the interest rate paid, so that's if someone decides to repay their loan, basically, or they bought another house, so therefore the mortgage loan automatically was repaid. Collateralized mortgage obligations, or CMOs, were created. So these specifically dealt with the problems, or the characteristics, I should say, of mortgages. And while CMOs and CDOs have many advantages to both buyers and sellers, there was a significant problem. How do you price them? They're not like a bond, which is very easy to evaluate, because once you know its coupon rate, date to maturity, and the face value, you can easily do calculations around that to calculate the price. The problem with the CMOs and the CDOs is you really didn't know what was in them. So, this was kind of different from a bond. These instruments were just like bonds, and there was interest rate risk as well. So, that was a common characteristic, but there were also other rather unique characteristics, like this early repayment, when some of the mortgages dropped out, basically, of the bundle, if you like. Also, they had different types of mortgages. They had the fixed rate mortgages and the ARM mortgages, and then balloon mortgages, and then negative amortization mortgages, etc. So it became difficult to compare different mortgages to gauge correctly the different risks that existed within these CMOs in particular. This is a nice visual that shows you the structure of the CMO market. The point here was that once you got this pool of mortgage loans, which makes up the CMO, basically you could then get the credit rating agencies, so that they played a role in this, to rate those CMOs. How like a bond are they? Most of them they rated at AAA. So you can see AAA senior tranche. So the implication there was that there'd be less loss coming from defaults or repayments. There'd be lower risk, and there'd be lower yield than on the CMOs that contained less high quality mortgages, and etc. And certainly one of the major causes of the current crisis, or I should say the crisis came in the late 2000s, 2007 really, and 2008 was the main part of the crisis. But the reasons, one of the major causes of it was the misuse of this Gaussian copula. Now, Gaussian Gaussian just means the normal distribution, and then a copula, as you're going to see, is the idea that you can combine the default distributions of different types of mortgages together. And this is due to some research that was done in the area of finance, and basically that's exactly the formula that was used by the traders to try and price these things. Adding to the pressures resulting in the global financial crisis was also the fact that, we talked about this pretty much at length, we had these subprime mortgage loans. So this was a home mortgage where the borrower really didn't qualify to get a loan. If you want to see more about how that was involved in the Great Depression, or how the Great Depression unfolded, Great Recession, I mean, not depression, Great Recession, which was at the end of the 2000s, then you should watch the movie The Big Short. It's really very good. And it lays out some of these financial instruments like CMOs and CDOs. It's even more complicated than this, because some of the payments on those CMOs could be insured. And so there was an insurance product that you could buy to try and insure those payments as well. So not only were these loans given out to people who couldn't afford them, in essence, but also there was a misalignment of incentives here. So the reps coming from the outfits that were selling these mortgages, Countrywide probably was the worst, and Countrywide is no longer with us, I'm afraid. It bankrupted itself. But its reps, had an incentive to issue mortgages as they got big incentive bonuses. I mean, if you give a big carrot to a worker for doing something, you're going to see that done in spades. And so these guys went out and they sold mortgages like crazy. They got mortgages like crazy for properties. And basically, in many cases, the properties that were being bought, the buyers really couldn't afford them. But by that time, the mortgage reps who'd basically sold these mortgages, that they'd moved on. Here are some questions. I think the first question is kind of interesting. It's about how the housing market, which was once kind of lauded in the US as very much part of the American dream, if you like, American way of life as well, that it turned into a bit of a nightmare during the financial crisis, for sure. And owning a home is still an important thing, but I think it also has instilled in a lot of people some nervousness about, not taking on more than you can afford at any point in time. So how much of an impact does the housing industry have on the overall economy in the US? So there are a lot of different businesses that are involved with homes, from Home Depot, Lowe's, anyone supplying double glazed windows up in the northern part of the country, to air conditioners, to washing machines, dryers, fridges, stoves. Oh gosh, a whole load. Paint. So, and this last question is interesting. So you've been renting an apartment for 10 years and have finally decided it's time to buy a home. What are the advantages of owning a home? Well, one of the big advantages, of course, is that you can do whatever you want with it. With an apartment, you can't, because it's not owned by you. So each month you pay your mortgage. As you begin the process, you notice that the most of the mortgage payments go towards the interest, not the principal. Please explain. Well, it just does go towards the interest first of all, because that's the way it's devised, and you pay off the interest before you pay off the principal. And this is the end of the chapter. So thank you very much for listening.